Good morning, everyone. Hope your studies are going well. And the Institute of Chartered Accountants of India, they have released their statutory update for September 25 examination. Now, here we will be discussing about the important updates which will be applicable for the students who are writing their examination in September 25. So, basically, questions can be asked even in multiple choice questions, or even say theoretical questions can be asked here from the statutory updates which have been provided by the institute. First, the statutory update is relating to the provisions of tax deduction at source. So, they are saying that if certain payments are made to the units which are located in International Financial Service Center, and these units are claiming deduction under section 80 LA, then payments which are made to these units, there will be no requirement of tax to be deducted at source. So basically TDS will not be made by the payer when making payment to the units of the International Financial Service Center. So they have provided this is a list of the payments which is received by unit of International Financial Service Center. So you can go through once these list of the list where TDS will not be made. Basically the that unit which is located where in International Financial Service Center is claiming deduction under 80 LA, hence they are not liable to pay tax. Therefore whatever payments are made by payer of this nature, there will be no requirement of TDS. For example, if the recipient unit is a banking unit which is located in International Financial Service Center, and the payment is in the nature of what? Interest, or say professional fees, referral fees, brokerage income, commission income on factoring and forfeiting services. So then in that particular circumstance, when the payer is making the payment of these expenditures, you will not be required to deduct the tax at source. Similarly, if insurance commission is paid to IFSC Insurance Intermediary Office, then there will be no requirement of TDS. Interest income on ECBs or loans, dividend income, commission on income there, which we have discussed above also, on factoring and forfeiting service, same as in paid to a finance company, or similarly this payment is made to a finance unit, then professional fees is paid to a fund management entity, dividend income is paid to a broker or dealer, investment advisory fees is paid to investment advisor, distribution fees and commission fees is paid to registered distributor. Once you can go through the same. Professional or commission fees paid to the custodian, credit rating fees to credit rating agency, investment banking fees to investment bankers, then trusteeship fees to debenture trustees, and commission income to International Trade Financial Services or ITFS, and technical fees or professional fees or commission income which is paid to fintech entity. In that particular circumstance, tax will not be required to be deducted at source. Basically, TDS provisions will not be applicable in above cases if the payee furnishes a statement cum declaration to the payer containing the details of the previous years relevant to the 10 consecutive assessment years for which the SSC outs under 80 LA. Basically, they have to give a statement cum declaration to the payer, and such statement cum declaration is to be verified, furnished and verified for each of the previous years relevant to the 10 previous years for which the payee outs for the benefit of the deduction under 80 LA. Then payer will not be making deduction at source on such payments which are made or credited to the payee after receipt of such statement cum declaration. And he has to furnish the particulars of the payment made to the payee on which tax has not been deducted in accordance with the statement of deduction of tax at source. Okay, so this is about just you remember this for this, that the units which are located in International Financial Service Center and they are claiming deduction under 80 LA, whatever these payments have been specified made to these units, then tax is not required to be deducted at source. Similarly, it has also further it has been provided that tax is not required to be deducted at source. Tax is not required to be deducted on interest paid by these IFSC banking units, interest paid by IFSC banking units on deposits made on or after 1/4/2005 by NR. So if IFSC banking units is making payment to interest to these non-residents or NOR in India, or in respect of deposits which have been made, or if they have taken borrowings from that NR or NOR, then in that particular circumstance, IFSC banking units, while making payment of interest, they will not be required to deduct, say, tax at source. Then in 194, and we have seen in case if there is a cash withdrawal exceeding 1 crore and 3 crores in case of cooperative society, then in that particular circumstance, tax is required to be deducted at source at rate of 2%. So, of the sum in excess of 1 crore or 3 crore. Now, they have notified that the provisions of section 194N, the provisions of section 194N shall not apply to foreign representations duly approved by Ministry of External Affairs. Foreign representations duly approved by Ministry of External Affairs. So 194N will not be applicable in respect of foreign representations duly approved by Ministry of External Affairs, including diplomatic missions, agencies of United Nations, international organizations, consulates, and offices of honorary councils, which are exempt from paying taxes. Fundamentally, they are exempt from paying taxes. Therefore, whenever they are making withdrawals of cash exceeding 1 crore in that particular circumstance, no TDS will be made under 194N. Then they have also further notified under 197A subsection 1F that if payments are made to these persons, these notified persons, tax will not be required to be deducted at source. So basically, the central government has notified that no tax is required to be deducted on payments. No tax is required to be deducted on payments which are received by. In case the payments are received by whom? These credit guarantee fund trust, because their income is exempt. Basically, their income is exempt. Remember, if your income is exempt, then if you are receiving any payments from any person, that person who is making payment to these entities whose income is exempt, they will not be required to deduct tax at source. That is credit guarantee fund trust for, say, small industries, for micro industries, national credit guarantee trustee company, then credit guarantee fund established and financed by central government and managed by National Credit Guarantee Trustee Company Limited. In this particular circumstance, tax will not be, say, required to be deducted. Further, they are providing that necessary compliances which are required to be made by the seller as well as the buyer in that particular cases. Similarly, under section 206C1H, no TCS will be applicable. No TCS will be applicable in respect of, the following units. That is basically where the buyer, seller is required to collect tax at source. So TCS provisions under section 206C1H, TCS provisions under section 206(1)H will not be applicable where the buyer is a unit, where the buyer is a unit of International Financial Service Center. In that particular circumstance, the seller will not be required to collect tax at source on necessary compliances. Once you can go through the same. So these are just the notifications which have been issued where TDS and TCS provisions are not applicable. So maybe they can ask the same in even in MCQs or in questions also. Now very important guidelines have been issued relating to compounding of the offences. So in case, because it's an economic offence, you can get the offences compounded by making payment of compounding amount. So here now they have issued revised guidelines for compounding of offences. A circular has been issued by the CBDT in this regard, and let us now see these guidelines. This is very important one. This is important, and questions may be asked from these compounding guidelines. Even, multiple choice questions can also be framed relating to what, how much times you have to pay the compounding charges. Okay. So let us now start with what these guidelines. Basically, these guidelines are issued by circular number 4/2025. So what do you mean by compounding? As you are aware, before or after institution of the proceedings, the person can get instead of prosecution, pay this much amount of money, monetary amount, and you will not be prosecuted in that particular circumstance. So basically, compounding of an offense is a mechanism whereby the defaulter is deprived of major legal consequences by affording him an opportunity to pay certain sum of money to escape prosecution. You remember, whether it's in GST law or whether it is in income tax law or whether it's economic laws, basically what they don't want that you should be prosecuted. You should not be put in bars. But the thing is, you pay this much amount because it's an economic offense and get your offense, say, compounded. So basically, compounding is what? Payment of certain sum of money to escape, say, prosecution. Then here, the specified offenses can be compounded by the competent authority either before or after the initiation of the proceedings. So that can be before initiation of the prosecution proceedings or after initiation of the prosecution proceedings, you can get the offenses compounded. Then next question they have been specified in the circular is, are there any offense under the Income Tax Act which are not compoundable? Basically, all the offenses under the Income Tax Act are compoundable under the revised guidelines. Now, remember, these revised guidelines have been made applicable with effect from 17th of October 2024. These revised guidelines have been made effective from which date? 17th of October 2024. So these guidelines shall come into force from 17th of October 2024, and it will apply to what? Pending applications, filed earlier but not disposed of also. So you have filed an application for compounding the earlier guidelines but is pending, then also for that these revised guidelines will be applicable. So these guidelines come into force on the date of issuance, that is 17th of October 24, and applies to all compounding applications. The same applies to what? All compounding applications filed after this date, as well as to the applications which have already been filed but not been disposed of. So if they have been filed in the earlier guidelines but they have not been disposed of, will be covered by the new guidelines. So they are asking now, question is whether revised guidelines are applicable on pending compounding applications, whether revised guidelines are applicable on pending compounding applications. If yes, whether applicant have to file a fresh application. So basically, I have already told you these guidelines will be applicable for even the pending applications which were filed under the earlier guidelines, and you don't have to file a fresh application in this regard. So revised guidelines are applicable on applications which are pending before issuance of these guidelines. The applicants whose applications were pending on 17th of October 24 are not required to file a fresh application or to pay any fresh application fees. But in case if the applications were filed earlier but they were rejected solely on curable defects, okay, some defects were there in the application and were rejected, fresh applications may be filed again. Now what are basically curable defects? Such as what? You have not paid the outstanding tax, interest, penalty or any other sum related to the offense. So fundamentally, the main purpose of compounding is that you firstly pay the tax, interest, penalty and other sums due. Then only they will be going for looking to the compounding. In case if you have not paid, then it has become your application, earlier application would have become defective. In that particular circumstance, that may have been, say, rejected. Or filing application, it may be a possibility that you have filed an application in incorrect pro forma, you have mentioned incorrect assessment year there, or financial year there, or incorrect section under which the offence was committed, or even if the non-payment or short payment of compounding charges which have been determined earlier, non-submission of undertaking regarding withdrawal of bill, etc. So these are all curable defects, and if your application has been rejected earlier, then in that particular circumstance, if it is of the curable defect, then you can definitely go and apply here in the new guidelines. Then whether the applicant whose application was rejected in earlier guidelines on ground being convicted, on ground of being convicted, is eligible to reapply for compounding of application as per the revised guidelines. In case he has been convicted in the earlier, guidelines, and his application was rejected earlier, in that case also he can reapply as per the in terms of the revised guidelines. So, in cases the rejection was solely on account of conviction, without examining the application on merits as per the earlier guidelines, then such applicants can, say, reapply in terms of the revised guidelines. Now, what are the conditions which are to be considered for compounding application? As we have seen, all the offences are compoundable. So basically, the compounding is to be made by whom? The jurisdictional principal chief commissioner or chief commissioner. So it is PCCIT or CCIT, Principal Director General of Income Tax or Director General of Income Tax. They are the competent authorities. We have seen in the section also. These are the competent authorities for compounding of the offences. And here, compounding application can be filed for 1 financial year, or say in case of TDS, quarter also, or if it can be more than 1 financial year also. Then in that particular circumstance, it is known as consolidated compounding application. So here the compounding application may be filed for offence pertaining to 1 financial year in case of taxpayers, or 1 quarter in case of tax deductors, or say for multiple years or quarters. The compounding application filed for multiple years or quarters, they are referred as what? Consolidated compounding application. So if you are, say, filing compounding application, and that relates to more than 1 financial year, in that particular circumstance it is known as consolidated compounding application. Then if there are more than 1 rejected application under the previous guidelines, 1 consolidated compounding application may be filed for all such previous applications. Okay. Then whether the applicant can withdraw a compounding application and file a new application. Now they are asking whether the applicant can withdraw compounding application and file a new application. Definitely you can say withdraw a compounding application and file a new application. In that particular circumstance, once an application has been filed, then again you are filing an application, then you are required to pay higher charges, say 1.2 times, then again 1.4 times, then again 1.6 times. We'll discuss the same subsequently. So they are stating that the applicant can file a new single application or a consolidated application after withdrawal of the earlier application. This is possible. However, such new application shall be treated as a subsequent application and higher compounding rate shall be applicable, which is discussed later on. Okay. then higher compounding rate you have to pay. Whether applicant is required to file compounding application for all the offences together? No, it's up to your wish. For these offences, we want to get it compounded. We have committed 5 offences, out of which we want to get 3 compounded. Then we have to make even a consolidated application can be made, but for 3 offences, not for all the 5 offences. So whether applicant is required to file compounding application for all the offences together, for which prosecution proceedings have been initiated? Basically, no. The applicant may apply for one or multiple offences in an application. His application cannot be rejected on the ground that he has not applied for particular offence for which notice for prosecution has been issued and proceedings are under progress. So fundamentally, it is up to him for which offences he want to get their compounding done. Then, is there any limitation as to number of times the compounding application can be filed by a person? It's better not to be an habitual offender, but the thing is, there is as such no limitation. But if you are a habitual offender, then definitely they may have their right to reject your application also. So fundamentally, there is no limitation on number of times a person can file a compounding application. However, the competent authority may reject an application by a person on the ground of being a habitual offender. Now, what is the time limit for filing the application? As such, it has not been given. You can file an application even before or after institution of the prosecution proceedings. So, the compounding application or the consolidated compounding application may be filed suo motu at any time after the offence is committed, irrespective of whether the department has a knowledge of that offence or not. The compounding application or consolidated compounding application may also be filed after the institution of the prosecution proceedings. Now, is there any time limit for filing an application for compounding? As I already told you, no, an application can be filed at any time after committing the offence, regardless whether the same has come to the notice of the department or not, or even after prosecution proceedings have been launched, then also you can file an application. Now, remember compounding fees. In case compounding application fees, basically, it is single application, fees is rupees 25,000. Single application, fees is rupees 25,000 per application it is, and consolidated compounding application, fees is rupees 50,000. So, for compounding applications or consolidated compounding applications filed on or after 17th of October 24, the applicant has to deposit non-refundable compounding application fees of rupees 25,000 for a single compounding application. It's a non-refundable. Remember, MCQ can be asked, and 50,000 for consolidated compounding application per such application. Fees is not refundable, but same is adjustable against the total compounding charges. Fees is not refundable. In case whether the compounding application fees is adjustable against the compounding charges payable, yes, the fees is adjustable against the compounding charges which are payable in the particular application. Okay, Cross application adjustment is not allowed. However, compounding application rejected for any reason, the application fees is not refundable nor adjustable against any subsequent application. Then whether compounding is allowed if the application for such offence was previously rejected, yes, as per the new guidelines, the same can be allowed. If so, whether separate application need to be filed for more than one application rejected under the previous guidelines. So here, if the application has been, say, rejected on the under the previous guidelines, in that particular circumstance, we can make consolidated compounding applications also, and fees will be charged accordingly. So in case the earlier, application has been rejected on account of curable defects, and now you can file a consolidated compounding application also relating to more than, say, one offense, and compounding fees will be charged accordingly. Then you get your offense compounded, then what you have to do is you have to pay all your tax, interest, other sums relating to the offense before making the compounding application. So all outstanding tax, interest, penalty and other sums due relating to the offense for all the relevant years or quarters the case may be, for which compounding has been sought, the same is to be paid before making the compounding application. Okay. And in case if any tax is still due, then in that particular circumstance, the department will intimate the applicant that this much amount is due, and he has to pay the same within 30 days of the intimation. He has to pay the same within 30 days of the intimation, or such period not exceeding 3 months as may be allowed by the competent authority. Then the compounding application or the consolidated compounding application case may be shall be considered valid only consequent to the payment of the demand pertaining to the offence for respective years or quarters. Then he has to undertake, these are the conditions basically, as to applicant is to undertake to pay the compounding charges. Compounding charges will be determined by the compounding authority, and he is also required to withdraw the appeals. So for these are the points which you have to see here. That is, you have to make a compounding application to the prescribed authority. Time limit as such is not there. You have to make the payment of compounding fees. Prior to making the application, you have to pay the taxes, all dues. Then you have to make an undertaking to pay the compounding charges within the stipulated period, and then withdrawal of the appeals. The person who has, filed a compounding application has to withdraw the appeal filed by him if any relating to offence sought to be compounded. In such case, appeal has, say, mixed grounds, and one or more of which is relating to offence and other is not relating to offence. In that particular circumstance, for those where compounding application has been made, those grounds are required to be withdrawn. So whether an applicant is required to withdraw the appeal related to offence sought to be compounded before filing the compounding application, basically no such withdrawal is not required. Such withdrawal is required. How no such withdrawal is required? However, applicant shall undertake to withdraw appeals, including writ petitions, if any relating to offences being compounded, and in case where appeal has mixed grounds of appeal related to offence to be compounded. Then next is about the consolidation of offences. Then application for compounding of an offence under 276B or 276BB by an applicant for any particular 10 should cover all the defaults constituting offence under 276B and 276BB in respect of that 10 for such period. The total default on account of non-payment of, say, TDS/TCS for a quarter shall be considered by combining the defaults of all statements filed by TDS deductor in respect of the relevant quarter. Now next is about the defective application. Basically, if defects are curable in nature, then that can be cured. Otherwise, the application stands rejected. So basically, applications which do not fulfill the specified conditions or are not acceptable due to curable defects, such as say if you have not paid the tax, outstanding tax, interest, penalty, application has not been filed in correct pro forma, or applications filed for incorrect financial years or assessment years or under incorrect sections. These are considered as defective. However, these applications which have been considered defective can be revived without additional payment of compounding fees, provided defects are cured within 1 month from the date of intimation of defect. And in case if the defect is not cured within the time limit, the defective application will be returned back. If any application is filed further, then it will be considered as subsequent compounding application. So any further application filed for same purpose, then it will be considered as subsequent compounding application and higher charges will be payable. Then offences compoundable with the approval of the higher authority. We have seen that the principal chief commissioner or chief commissioner, principal director general or director general, they are compounding authorities. Now here the competent authority may compound only with the approval of the chairman of CBDT. These are the offences where compounding will be only on the approval of the chairman of the CBDT. So in case of an offence in which the applicant has already been convicted with the imprisonment for 2 years or more, if you have already been convicted with an imprisonment of 2 years or more, with or without fine by a court of law, so in that case, prior approval of chairman of CBDT will be required. In case of an offence, now this is relating to another offence under other law. It may be under say customs or other law, for which he has been prosecuted for imprisonment for 2 years or more, with or without fine by court of law. Then also, if applicant, as per the information available on basis of investigation conducted by central or state agency, has been involved in any anti-national or terrorist activities. Okay. In such cases, competent authority will consult the relevant agency and seeks input regarding the activity and its implications for the purpose of deciding whether it is a deserving case of compounding or not. Then, in case of person being an applicant, the person being other than the main accused, it is proved that applicant facilitated tax evasion through mechanisms and use of entities for laundering money, generation of bogus invoices, sale or purchase without actual business, by providing accommodation entries in any other manner. In that case also, and if the offence is directly related to say black money or an offence under section 275A or 275B, in these cases, prior approval will be there of the board commissioner in this, then only the compounding will be possible. So they are asking whether offence can be compounded where applicant has been convicted for imprisonment for 2 or more years. In that particular circumstance, yes, even if the applicant is convicted with an imprisonment for 2 or more years for an offence under the Income Tax Act or under any other law, then also compounding will be there, but with the prior approval of the chairman of CBDT. And whether cases involving other agencies such as ED and CBI can be compounded, yes, they can be compounded. Then applicant is found to be involved in such activities, offence shall be compounded only with the approval of the chairman of CBDT. Then authority competent to compound the offence, as we have already seen, it is the principal chief commissioner or chief commissioner, principal director general or director general of income tax is basically the authority competent to compound the offence. It is what? They are the authorities. And in case a person has been convicted of an offence for non-payment of TDS and TCS in respect of both resident and non-resident payees, then jurisdiction over such person normally lies with one jurisdictional, more than one jurisdictional charge. In such case, the principal chief commissioner or chief commissioner, principal director general or director general in whose jurisdiction compounding application is been filed will be regarded as what? The competing authority. Then what is the compounding procedure? What is the compounding procedure? So basically, when the compounding application has been filed, the competent authority will obtain a report from the assessing officer or the assistant or deputy director, and then they'll pass the order if application is not acceptable. In cases where the compounding application is not found to be acceptable, then the competent authority, they have to dispose of the application with a reasoned order. That is, speaking order means a reasoned order. And the order must be made within 2 months from the end of the month of the receipt of application. This order is to be made within 2 months from the end of the month of the receipt of the application as far as possible. Then in case, if the application is found acceptable, then in that particular circumstance, the compounding authority, they will intimate to the applicant the compounding charges and other pending liabilities. And such intimation is to be given within 2 months from the end of the month in which the application is being, say, received. Okay. That is also the same timelines. Then this payment is to be made the payment is to be made within, say, 1 month from the end of the month of receipt of such intimation, these compounding charges. And on request of the applicant, further extension can also be made. Now here, the competent authority may extend the period up to 6 months. The competent authority may extend up to 6 months. Extension beyond 6 months but up to 12 months shall not be permissible except with the prior approval of the Principal Chief Commissioner of Income Tax of the region concerned. Okay. Beyond 12 months but up to 24 months. So 6 to 12, 12 to 24 months. From the end of the month, it will be here regional CCIT, then here chairman of CBDT or member of CBDT authorized by the chairman. Then no extension. Remember, no extension will be allowed after 24 months from the end of the month in which the receipt of such intimation of compounding charges there. So these timelines you have to remember can be asked. Then if you do not pay the compounding charges within the specified timelines of extended period, then your application shall stand rejected. So where compounding charges is not paid within the time allowed or extended, the application will be rejected and prosecution proceedings shall be initiated if not already so done. The complainant shall serve the copy of prosecution complaint to each accused within 15 days of filing the complaint to allow prompt filing of the compounding application. Okay. In case where prosecution proceedings have been instituted, the order of acceptance or rejection of compounding has to be brought to the notice of the court immediately through prosecution counsel, where the said prosecution proceedings are pending before the court. Now, what is the time limit of, now we have paid the compounding charges, then they will make a compounding order. When you pay the compounding charges within 1 month from the end of the month of payment of such compounding charges. So, where the payment of compounding charges is made within the time or extended time so allowed, the competent authority shall pass compounding order within 1 month from the end of the month in which the total compounding charges are paid. So, it is within 1 month from the end of the month in which the compounding charges have been so paid. Now they are saying whether the time for payment of compounding charges may be extended beyond 24 months. No. We have seen it can be extended up to 24 months. It cannot be extended beyond 24 months. So beyond 24 months extension is not allowable and application shall be rejected, followed by initiation of prosecution proceedings in case the same has not been initiated already. However, the applicant can file a new application for same particulars which shall be treated as subsequent application for the purpose of determination of the compounding charges. Then, as per the revised guidelines, the payment for compounding charges may be extended up to 24 months from the end of the month in which the compounding charges were intimated. For pending applications where payment initiation was made before the issuance of the revised guidelines but not fully paid, how the period of 24 months will be calculated. Additionally, will such applications require approval of, say, extension? So basically here, the pending application on which date? On 17th of October 24, where compounding charges were not fully paid within the time allowed as per the earlier guidelines, or where the time has not been elapsed, period of 24 months will be counted from the end of October. Period of 24 months will be counted from the end of the October, that is end of the month of the issuance of guidelines. And extension of timelines will require approval as per the prescribed authorities. Then, whether you are required to pay any interest or say additional charges, no interest or additional charges are not applicable or extension allowable under the guidelines. Further, in cases on the date of issuance of revised guidelines, additional compound charge that is chargeable under the previous guidelines shall not be applicable and compounding charge shall be determined as per the revised guidelines. So compounding charge will be basically as per the revised guidelines. And this compounding charge will be determined by the competent authority, the compounding authority basically. And here tax means what? Tax plus surcharge plus cess, but does not include interest. Remember. So for the purpose of computation of compounding charge, the word tax means what? The tax including surcharge and any cess by whatever name called as applicable. However, interest shall not be included in tax to be considered for compounding charge. Now here, if first application is made, you will be required to pay normal compounding charge as determined by them. But if you have made an earlier application, first application, now you are making again a second application, or say third application, or say fourth application, then it will be 1.2 times. Third application it will be 1.4 times. Fourth application it will be 1.6 times, and likewise it will increase. So here the compounding charge, this is very, very important, remember. The compounding charges for first compounding application, or say consolidated compounding application by person has to be computed for each offence disclosed in the application. So here for compounding charge for first compounding application or consolidated compounding application by a person has to be computed for each offence disclosed in the application. Further, any application filed subsequent to first application, shall be counted as second application, third application, fourth compounding application, or consolidated compounding application, and so on. So if a person has applied for compounding offence, the type which he has applied for earlier, same type of offence he is applying subsequently, then the charges for subsequent offence shall be 1.2 times. Then again third will be 1.4 times. Fourth it will be 1.6 times, and so on. So this is, remember, this is important. and if subsequent application includes any offence, the type of which has not been disclosed in earlier applications, the compounding charges for the said offence shall be computed as per the charges given in these guidelines. And while compounding applications have been filed in accordance with the prior guidelines and they were pending or rejected, they have been have been compounded. Such applications filed prior to issuance of these guidelines shall together be considered as first compounding application. So remember, if you have made compounding application in earlier guideline, say for any particular offence, you have made here, this has been rejected, this has been accepted and compounded, or this may be pending, so that will be considered as, all these will be considered as one application which has already been made. So you make under new guidelines, your charges will be 1.2 times. So here remember, if subsequent application where compounding application has been filed in accordance with the prior guidelines and are either pending or were rejected or have been compounded, all such applications filed prior to issuance of these guidelines, shall be considered as what? First compounding application. That will be considered as first compounding application. Then further, if the application is made beyond 12 months from the end of the month, if application has been made beyond 12 months from the end of the month in which prosecution complaint is filed, beyond 12 months from the end of the month in which the prosecution complaint has been filed, the compounding charges shall be increased by 50% of the amount calculated. Say if amount calculated is 1 lakh, then it will be 1.5 times of 1 lakh. That will become what? 1,50,000 when it has been filed. These two points are important. This is important. Remember, this can be asked practically. So, what will be the date of application in case of carried forward application? Original date or the date of issuance of revised guidelines. These guidelines have been issued on 17th of October 2024. So the applications pending on 17th of October shall be governed under these revised guidelines. Then date of pending application. Date of such pending application shall be the original date of such application. It shall be the original date of such application for any purpose. Then how the compounding charges shall be calculated for applications pending before the issuance of these guidelines. So basically, the compounding charges for pending application, they are subject to redetermination. They are subject to what? Redetermination as per the revised guidelines. All pending applications, whether for single or multiple years or quarters, shall be treated as first compounding applications, and compounding charges shall be recomputed for each offence disclosed in the application. Now, if a new consolidated application includes a year for which application was filed earlier and then withdrawn, whether the partial compounding charges paid for such year for which the application is withdrawn can be adjusted against the total compounding charges towards the consolidated application. So we have made an application earlier, paid partial compounding charges, then we have made withdrawal the same, and now we are again making the application under the new compounding guidelines. So they are saying adjustment won't be made. No, the partial compounding charges paid for the year for which application is withdrawn can be adjusted against in new consolidated application only towards the offence and the particular year for which the payment was made. If the offence is there and particular year for which payment was made is there in the new application, then only adjustment will be there, otherwise not. Then an applicant has filed compounding application under earlier guidelines 2 of which were rejected on account of curable defects, 2 were compounded, and 3 were pending for the issuance of these guidelines. How should the applicant file a compounding application after issuance of these guidelines, and how new applications will be treated? So basically, no action is pending for which the applications have been compounded, okay, because it has already been compounded. A consolidated application may be filed for all applications which were rejected on account of curable defects. You can make a consolidated application, and no fresh application required to be filed for pending application. Pending application, fresh application is not required. Then all pending applications, whether single or multiple years or quarters, shall be treated as first compounding application, and compounding shall be charge shall be determined for each offence disclosed in the application. Then the fresh consolidated application for rejected applications will be considered as second application. The pending application, first application, fresh application will be second application. Accordingly, the applications filed after issuance of these guidelines shall be regarded at a subsequent application, second application, and compounding charges will be, say, 1.2 times for each offence in the application. As I already told you, what is the rate of compounding charge is based on sequence of the application as well as offence applied for. If a subsequent application includes an offence which has been included in the earlier application, it shall be liable to a higher rate of 1.2 times in the second application. This is second. In third, it will be 1.4 times. In fourth, it will be 1.6 times. Irrespective of the fact, the offence and the year of offence are same in subsequent application, and earlier application was rejected or pending or even compounded. Then, however, if subsequent application includes offence which were not included in any compounding application, okay, earlier, then it will be treated as first time offence, and normal compounding charges will be payable. And let us see this. An applicant has filed different applications on different dates to compound different offences. Now, he has filed under 276B offence. Status has been compounded. Okay. Sequence of application is not there. Then again 276B, this is rejected. Then on 17/9/24, pending was there 276D. Sequence of application here, it's pending. So here basically it is on 17/9/24, it is pending. This will be regarded as first application. No fresh application will be, say, required here. And in this case, normal compounding fees would be payable. Then we have filed again on 1/11/24. Single application has been filed for each application rejected earlier. Under 276B offence, we have filed again for each application rejected earlier. So as this is the first application, this will be considered as what? Second application. The application filed on 15th of January, which has been compounded, 18th of August, which has been, say, there, rejected. These are the same section. So this will be considered as second application, because earlier application either accepted, compounded, or say rejected, or say pending. In the same section, you are again applying now, it will be a second application. So it will be considered as second application. How much charges will be there? 1.2 times now. It will be 1.2 times. Then on 18/12/24, again they have made a consolidated application, same section. So this will be a third application now. First earlier made, second here, and third now. Charges will be 1.4 times. Then they are again making under 276C. This has already been compounded. Now it is it will be considered as second application. This will be considered as second application because once application was already been made under 276A relating to 1890. Now it is relating to 1920. Charges will be what? 1.2 times. And 275A. No application was made earlier. So it will be, it is first time applied, normal rate will be there. Okay. So remember, if they have already been made in the earlier laws compounded, they have been rejected or they are pending under same section and you again now applying in that particular circumstance, that will be considered as a second application. Then they are asking whether compounding application may be filed after launch of prosecution, and if yes, how the compounding charge will be determined. So if the application is made within 12 months from the end of the month in which prosecution proceedings have been launched, then you will be required to pay the normal compounding charge. But it's filed after the expiry of 12 months. It's filed after the expiry of 12 months from the end of the month in which prosecution complaint has been filed. The normal charges will be increased by so it will be, say, if the normal charge is 1 lakh, it will be 1.5 times. Now here say an assessee has made default in TDS for 3 months during the financial year 1920. Okay. The prosecution has launched on 1/4/22 under 276B. Date of launching of prosecution proceedings is 1/4/22 under section 276B defaulted TDS. Normal compounding charges are determined how much? They have determined 45,000. Now scenario 1 is no earlier application rejected. No earlier application rejected. Case 1 is what? We have made a compounding application within, say, on 10/12. It's less than 12 months. It's less than what? 12 months. Okay. From the end of the month. This is pending on what? 17th of October. So here normal compounding charges would be payable, that will be 45,000. But in case the application is made on which date? On 31st of October 24. Now this is what filed under revised guidelines, but it is after the expiry of 12 months from the end of the month in which the prosecution has been, say, initiated. Now your compounding amount will be what? 45,000 into 1.5 times. Okay, since it is made after the expiry of, say, 12 months. Scenario 2. First application was rejected. This application was rejected and now revised application has been filed. So this has been rejected. So this will be regarded as what? Second application. Second application. And when second application is filed, the compounding charges will be 45,000 into 1.2 times. 45,000 into 1.2 times. Then since the application is not made within 12 months, therefore it will become further into 1.5 times. So the amount will be how much? 45,000 into 1.2 into 1.5. 45,000 into 1.2 into 1.5. That is 81,000 rupees. That is 81,000 rupees. So first is that normal charge 1.2 times because it's a second time application, and then since not made within time limit, it is what? 1.5 times of the same. So this can be asked in examination. This is very, very, very important. Remember the same. Now here, in case if there are any co-accused, say if a company is there and directors are there, they can be co-accused. Similarly, in case of HUF, Karta or member of the family, likewise in case of firm, partners can also be there. So where an offence under this act has been committed by a company or HUF, an application for compounding may be filed separately or jointly by main accused. Separately it can be filed or co-jointly by the main accused, that is company or HUF, and or the persons deemed to be guilty of the offence, okay, which are referred as co-accused. So in case the offence by a company or HUF, the main accused or co-accused may separately make an application or they can make co-jointly also. And on payment of compounding charges for offence by any one of them separately or jointly, the competent authority shall compound the offence of the main accused as well as what? The co-accused. Then in case liability of company for an offence is committed prior to commencement of the corporate insolvency resolution process ceases due to provisions of section 32A of IBC, then prosecution proceedings against co-accused can still continue. In such a case, compounding application and payment of compounding charges may be made by co-accused or the main accused company. Then whether co-accused can file compounding application under revised guidelines? Yes, co-accused may apply for compounding offence separately or co-jointly. Then whether compounding application of co-accused was rejected earlier on the ground that main accused has not filed the compounding, whether such applications will be eligible for filing again. So if compounding application of co-accused was rejected because the main accused has not filed the compounding application, whether applicants will be eligible for filing again. If yes, whether the application shall be regarded as subsequent application. So yes, other than the case where application was rejected in past on merits, any co-accused applicant is eligible to file compounding application again separately or say co-jointly, and such application will be regarded as subsequent application for determination of compounding charges as 1.2 times will be payable. Similarly, where compounding application of main accused was rejected, main accused was rejected on the ground that co-accused has not filed the application or given undertaking, whether such application will be eligible for filing again. Yes, here also. And if whether such application will be regarded as subsequent application, such application will be regarded as subsequent. Both ways, if main accused has filed, co-accused has not filed, co-accused has filed, but main accused has not filed. Then if any application filed by co-accused or accused under previous guidelines is pending, whether they are required to file fresh application? No, they won't be required to file the fresh application. Here, the consolidated application shall be considered as first application for the purpose of determining the compounding charges. Then if the application is filed by main accused or co-accused or by both of them co-jointly, whether separate compounding fees shall be applicable for co-accused or no. So basically, no separate compounding fees for co-accused shall be payable, irrespective of the fact that application has been filed by main accused or co-accused or by both of them co-jointly. Only compounding charges will be determined, which will be payable. So once payment is made by the applicant, being main accused or co-accused or both of them jointly, competent authority will compound the offences for main accused as well as the co-accused. Where person other than main accused or co-accused can file compounding application for compounding of offence of company or say HUF, no, person other than main accused or co-accused cannot make an application. It's a application is required to disclose its status, whether it's a main accused or whether it's a co-accused. Then can co-accused furnish undertaking for withdrawal of appeal as required in the guidelines on behalf of the main accused? Co-accused cannot make an undertaking for withdrawal of appeal. Such undertaking will be required to be made by main accused only, and the same must be attached with the application. Then if application has been filed only by main accused or co-accused, in such case against whom the name of compounding order shall be issued. So here the name of persons who applied for compounding, in their name the compounding order is issued. If co-accused have applied, the order shall include the name of main accused also. Further, in case main accused is applied, then the order will consider the name of co-accused also. So basically, this were the guidelines which have been issued for compounding. Remember, this is very important. If you do not make application within 12 months from the institution of the prosecution proceedings, in that particular circumstance, prosecution complaint has been filed, then in that case, your compounding charges will 1.5 times of the normal charges. And second time application, third application, charges increases. So this is all about our compounding, where discussion was there. So this is a very, very important that they can ask you, practical questions also here. Now, in relation to non-resident taxation, we have seen section 44 BBC. In case the non-residents are engaged in the business of operation of cruise ships, then 44 BBC is applicable. For that purpose, they have provided what are the conditions? What are the conditions which will be required to be fulfilled for being an NR to opt for the provisions of section 44 BBC. So these conditions have been specified. Basically, the assessee being a non-resident engaged in, say, the business of, say, operation of cruise ships. So basically, he has to operate passenger ships having a carrying capacity of more than, say, 200 passengers, or the length of 75 meters or more for leisure and recreational purposes. Appropriate dining and cabin facilities are there for the passengers. Basically, since it's a cruise ship, so they must contain the appropriate dining and cabin facilities. Then operate such ship on scheduled voyage or short excursions touching at least 2 seaports in India or same seaports of India twice. And operate such ship primarily for carrying passengers. Basically, they are operating for primarily for carrying passengers and not for carrying cargo. And operate such ship as per the procedure and guidelines, if any, issued by the Ministry of Tourism and Ministry of Shipping. Then the liaison on non-resident liaison office, they are required to submit the statement here. So basically, Form 49C has been notified, which is to be submitted to the assessing officer within 8 months from the end of the financial year. That liaison office is required to submit the statement within, say, 8 months from the end of the financial year. Section 285 provides for submitting the statement of NR statement by for in respect of their liaison office in India. Then in transfer pricing, safe harbor rules have been framed. Basically what safe harbor is. Safe harbor basically means that under 92 CB we have seen the central government has the power to make the safe harbor rules. So safe harbor means the circumstances. Safe harbor means the circumstances in which, the income tax authorities will accept the transfer prices or income is deemed to accrue or rise under 911 as which has been declared by the SSC. So in case if you declare the income as per the provisions of the safe harbor rules, then your transfer pricing, that whatever income has been there, the same will be, say, accepted. Accordingly, the CBDT has further provided these safe harbor rules, 10 TI, 10 TIA, 10 TIB and 10 TIC. They have been introduced for providing safe harbor rules for income referred under 911, which is chargeable to tax under the Act PGBP. Now 10 TI is giving the various definitions. Now who is an eligible assessee here? Eligible assessee is a foreign company. Eligible assessee is a foreign company engaged in the business of diamond mining, which has exercised an option for application of safe harbor rules under 10 TIA. Eligible business, basically it's a foreign company and is engaged in business of diamond mining. They engage in business of, say, diamond mining. Now eligible business means what? Business of selling raw diamonds in any notified special zones. Then what is gross receipts? That is aggregate of the amount paid or payable to eligible assessee. That is the, foreign company engaged in diamond business or to any person on behalf on sale of, say, raw diamonds, on sale of say raw diamonds by the eligible assessee. One is the amount which has been paid or payable to the eligible assessee or in his behalf, or amount received or deemed to be received by the eligible assessee or by any person on his behalf on account of sale of raw diamonds. Okay, so here receipt will be on sale of say raw diamonds. Relevant previous year is the previous year relevant to the assessment year in which option for safe harbor has been say exercised. Basically, raw diamond is uncut or unpolished, unassorted, unworked or simply slant, cleaved or bruted, not conflict diamonds as defined in Kimberley process, accompanied by Kimberley process certificate falling under the tariff of 71.02. So it's basically uncut, unpolished, unassorted, unworked diamonds. Then what is basically safe harbor? If the eligible assessee declared eligible business, income from eligible business in circumstances which have been specified under subsection sub-rule 2, the option for safe harbor exercise for such eligible assessee in relevant previous year 10 TIB shall be accepted by the income tax authority, being declared valid. Now remember what are the circumstances in respect of eligible businesses. The profits and gains, you remember this, profits and gains of eligible business chargeable to tax under head PGBP shall be 4% or more. It shall be 4% or more of what? The gross receipts of business. Safe harbor is 4% or more of gross receipts from such business. Then where the eligible assessee has exercised the option of safe harbor under Rule 10 IB in respect of eligible business in relevant previous year and such option is not declared invalid, then in that case any deduction under 30 to 38 shall be deemed to be fully given effect to. All deductions will be deemed to be given effect under 30 to 38 as we see under 4480. So WDV of the asset shall be calculated as if the assessee has claimed and has been allowed depreciation, and no set-off of unabsorbed depreciation or carry forward losses would be allowed. All deductions under 30 to 38 deemed to have been allowed. WDV to be computed as if the assessee has claimed and has been allowed depreciation. Unabsorbed depreciation, carry forward loss, basically will be, no set-off will be there of the same, and no set-off of loss from other business. No set-off of loss from other business or under other head shall be allowed from PGBP in respect of such business. And provisions of 92D relating to maintenance of and keeping of the and furnishing of information and document, and 92E for submission of report of chartered accountant as they apply in international transaction will apply here also. Now basically what is the procedure? The assessee has to furnish information in form 3C EFC, which is complete in all respects, before furnishing the return of income under 139 for the relevant previous year. And if the assessee does not exercise option for safe harbor, the income shall be chargeable as per the normal provisions of the Act. When the option will become invalid, the AO may declare the option for safe harbor as invalid by an order in writing, where the assessee has failed safe harbor by stating incorrect facts or concealed facts relating to the business. But before declaring the safe harbor as void, the AO must give the assessee a reasonable opportunity of being heard. The AO has to serve the copy of the order to declare option invalid to the assessee, and other provisions of the Act shall apply accordingly. Then mutual agreement procedure not to apply. So basically assessee is not entitled to invoke mutual agreement procedure under an agreement for avoidance of double taxation under 90 or 90A in respect of this eligible business, in case the assessee exercise the option of safe harbor rules and its option has not been declared as invalid. Then MAP will not be applicable. Then they are stating that set conditions and the activities notified for finance companies to be excluded from the provisions of section 94B. So basically 94B is a limitation of interest deduction, and it provides interest expense claimed by Indian company or PE of foreign company being borrower of on a loan from its associated enterprise shall not be deducted in computing the PGBP to the extent it is excess interest, that is over and above 30% of earnings before depreciation, interest, tax and amortization. So basically here finance company is excluded from the applicability of the provisions of this section, and finance company has been defined as a finance company as per International Financial Service Authority finance company regulations. So basically finance company as per the regulations means a financial institution separately incorporated to deal in one or more of the permissible activities. It does not accept public deposits from residents. It does not accept, say, public deposit from residents or NR, and is not registered with the authority as a banking unit. Okay, that is basically a finance company. Now, accordingly, CBDT has provided finance company located in International Financial Service Center shall carry out one or more of the following activities: lending in form of loans, commitments and guarantees, credit enhancement, securitize. These are the functions of the activities of finance company. Then factoring and forfeiting of receivables, functioning of global or say regional corporate treasury centers such as borrowing, lending, hedging of currency, commodity risks, etc. So the interest being paid by finance company being borrower in respect of any debt issued by NR shall be in say foreign currency. So these are the activities which the finance company is there, and then it will be excluded from the ambit of section 94B. So you can go through this once. Safe harbor is important. Remember, it is you declare your PGBP up 4% or more of the gross receipts. That is foreign company engaged in the business of say, diamond mining. So safe harbor, remember the same. So these are the amendments which we have discussed here, which has been given by the institute.